Hello, everyone, and welcome back. An October snapshot of the New York City real estate market reveals a nearly 24% jump in contracts, despite mortgage rates rising to nearly 8%. The burst of demand seemingly encouraged sellers to raise asking prices to their highest levels in 6 years. I would like to welcome my listeners in the United States and all around the world. I am Vince Rocco, and this is Talking New York Real Estate. At this hour, New York City properties going into contract increased last month after a sharp decline in September, according to a new report by StreetEasy. October is typically a busier month than September, when buyers are shaking off a vacation mindset or dealing with back to school. Notably, the increase in new contracts from September to October was close to a 5-year average of 26.7%, despite mortgage rates rising to a 23-year high. Rising mortgage rates can push some buyers to the sidelines, and that means more wiggle room for buyers who stay in the market going forward. However, cash is still king. The luxury market in New York City is thriving and seems to be continuing without boundaries. Who are these buyers? And are any of them foreign from foreign lands? Are they domestic, very wealthy people looking to buy at a good time? I have several giants in the industry here with me today to tell us all about that. We will have all that and so much more as Talking New York Real Estate gets underway on this Tuesday morning. And in the news this morning, federal authorities are investigating New York City Mayor Eric Adams for potential misconduct related to his alleged intervention in the approval process of the Turkish government's new high-rise consulate in Manhattan. The New York Times reported the investigation centers around Adams's alleged pressure on New York Fire Department officials to greenlight the building's occupancy, despite safety concerns raised by those fire officials. The mayor's involvement reportedly took place before his election 2 years ago. And once a beacon in New York City's residential market, sales of newly constructed condominium units fell to below pre-pandemic levels for the second consecutive month in October. The 181 contracts signed last month totaled $454 million, with a median listing price of $1.5 million, according to data from MarketProof. This is a 2-month back-to-back when numbers have declined, according to Cal Goodman from MarketProof. The numbers are definitely soft. While developers have more motivation to sell than homeowners who locked in historically low mortgage rates during the pandemic, limited inventory has stalled the new condo prices. Public libraries across New York City will soon be closed on Sundays in response to budget cuts announced by Mayor Eric Adams last week. Under the updated fiscal year 2024 budget released Thursday, every city agency will see a 5% budget reduction, including the police, sanitation, and education departments, as well as the public library system. New York, Brooklyn, and Queens public libraries said 7-day service will be eliminated, including ending Sunday service at most branches that offer it. And finally, Eataly's third New York City outpost opened in Soho last week. Located in a landmark building at 200 Lafayette Street, the store will offer Eataly's world-renowned authentic Italian goods, a specialty market with curated Italian and local delicacies, an Eataly Soho restaurant, and all-day pasta. Can you just imagine that? With me today are Jared Antin from Elegran Forbes Global Properties, Scott Harris, Brown Harris Stevens, and Nikki Field from Sotheby's International Realty. All right, everybody, thank you for being here on set with me today. Really excited to talk to all of you. So, like any real estate market, the luxury sector in New York City can experience so many fluctuations, and we've seen that. We talked about it before the show. Economic conditions, both globally and locally, can impact the market. For instance, changes in interest rates, stock market performance, and geopolitical events can influence buyer and seller behavior. Now, I said something at the top of the show, how October was really good based on the last couple of months. Why was October so good, Scott?
Well, first and foremost, there's so much liquidity out in the world. People are not investing in certain asset classes. They're more concerned about, if we're talking just about the luxury market, that they're on the sidelines with a lot of other investments, and they're looking at real estate, specifically New York, as being a real value now. I mean, that's the conversation I'm having with a lot of different buyers. They're just seeing value here, and they want to take advantage of it. You know, you saw, I mean, something like 65% of all deals were cash in recent quarters, and we try to track those numbers with Greg Heim, our economist here at Brown Harris Stevens, and those are shocking numbers. And it just goes to show how much liquidity is out there. I think that really is a driver, the combination of liquidity and value people see in the market.
But Nikki, so let's talk a little bit about value, as Scott just mentioned. So yes, there's a lot of liquidity out there. People are anxious, I think, and starting to get up again and wake up and want to get out there and make things happen. But when we talk about value, okay, how do you look at that? Are our properties valuable, more valuable today than they were in the past? Are prices where they should be right now? Could they be better? And what's motivating some of these, not necessarily only cash buyers, but just buyers in general?
It's a multiple of questions.
Yes, it
Good
is.
morning, Vince.
Good morning.
I'll try to step into this. I totally support Scott, though, on the interest and velocity of real estate investment. There's so many more wealthy people than there were pre-COVID. Ones that we don't know of, ones that have been stealthily collecting this enormous wealth. And literally all of them, I do not know one or have not heard of one that doesn't want to diversify their portfolio. They have obviously investments in their own businesses, financial investments, but the key element driving so many of these build-out of portfolios is residential real estate now. Why? You can use it. It's attractive, and you can brag about it. And if you're buying in key neighborhoods and regions, it's a lot of fun to have prime real estate. So specifically today, we're talking about luxury. Luxury is a tale of many markets. Luxury in one market may not be the same in others. In New York, luxury has been, and will remain on steroids. If you offer the very best in class, they will pay what they need to secure it. Now, in luxury in New York, we consider that the over $20 million market. It's all cash. It's immediate. It's self-gratification, but it has to be a very easy lift. And specifically, if you're asking about projections here, I continue to believe that branded hotel residences are and will be the biggest growth segment of our market. It's a very, very fast means to your goals. We call it the Ozempic for luxury buyers.
There's a term.
Fast, easy, no pain to get to your goals with a comfort level and confidence that it's a smart play.
All right, you define luxury as over $20 million. I happen to agree with that, but we get reports weekly and we hear people talking and defining the luxury market as $4 million plus. Okay, to me, $4 million, the old term meat and potatoes, okay, that's really not so grand any longer. Everything is $1 million or more. So 20 million and up. You happen to have several properties in that 20 million and over range. Tell us a little bit about the buyers who come through. Is it fast-paced? You get a lot of visitation, or is it just kind of that select buyer who wants to come and see something you have?
Well, the Uber market, I think most of us use the private offering to test it out to begin with. I think that's extremely important, particularly when you are offering these properties to very sophisticated portfolio collectors. They want, and we have found that the fastest way to meet the seller's goals is to offer privately the select property. And we did that successfully numerous times in these last couple of years. And then phase two, if you're not getting your buyer through that private offering, you've tested the price, you've tested the reaction, you've tested the market ability, and it puts you in a much stronger position to roll it out publicly. I'll give you an example. A year and a half ago, we rolled out a $170 million property in Greenwich, Connecticut. Tested it out. Our offers were in, but not meeting anyone's expectations, but it did help us regulate the rollout price. So when we went public a year later, we tested it for an entire year. Yes, we did. When we went public, we adjusted it to 150. Within 1 month, we had 140. Very solid buyer, international, but we got the job done because we knew more after that first year than we did. Than we would have if we had gone out publicly. And that's not the norm. It usually doesn't take that long. There are other instances where we've been really fortunate that the private offering will find those targeted people. How do you find those targeted people? Because so many of them are off the radar now. We used to know every billionaire. Forbes was very helpful with that. But there's so many more out there that are very discreet, not in any way reporting their income and looking for new opportunities. The purchaser of that $140 million property called and asked, where is Greenwich, Connecticut? He read about it. Didn't know this guy. He thought it was going to be a great compound for his
That's
family.
wild.
He bought it. He'd never bought anything in New York. He'd never bought anything in the United States. And no banker, no private wealth person that I knew had identified him in any way. That's that kind of wealth out there that we still need to target.
So, Jared, the luxury condominium market, everybody is drawn to it. The tall buildings, the skyline, the river views, park views, whatever. How is condo development doing right now? I get so many different stories of, the numbers are down, the numbers are up, visitation is up, visitation is down. But where are we really with buyers out there looking specifically for that new condo high-rise, that luxury property, that property that everybody is going to say, wow, look at where you just bought or look at where you just live?
It's definitely a mixed bag. It's a tale of multiple markets, and it all depends on a few things. One is, when the property came to market, when the property was priced, and how unique and how, scarce it is. So you look at 220 Central Park South as sort of the prime example of creating the next 15 CPW. And that property was done a great job by creating this club-like atmosphere. So we talk about wealth, we talk about money. We're in the experience economy now. Real estate does an amazing thing of blending both, an asset, but also the experience. And wealth wants to park their money in areas where they can enjoy their lifestyle without concern for prying eyes. So these communities, like at 220 Central Park South, were incredibly discerning and therefore incredibly in demand by buyers. And some buyers were turned away for, a multitude of reasons. So a property like that has held up substantially better even in the resale market, than a 157 or a 432 Park. There was an article in the Real Deal just yesterday, talking about the falling value of 157. Why? Because it was the first, but it's not the last, and it's certainly not the best. So you look at that, and you have certain properties that have come to market in prime that have done well. The Waldorf, I walked by it this morning again. The property probably hasn't done as well as they wanted to, but it's doing better than I suspected it would. Why? Because, again, you are compounding on the buying in New York thing. You're buying a storied property with an incredible set of amenities in a phenomenal city. So that property is doing decent, and it's attracting a ton of international buyers and some local buyers as well, much to many people's surprise, because they're looking for a certain lifestyle at a certain point in their lives. You have other developments that are just completely mispriced and or are not matched for the market where we are today, and they're sitting and struggling. You also see properties that, we're still trying to sell their last 5, 10, 15%. And those units are sitting for a reason because no one else snatched them up, and the developers are not yet eager enough to offer an attractive enough price to a bulk buyer to come in and just close it out.
Scott, so Jared just mentioned, a lot of foreign buyers to these properties, but also some, very wealthy domestic buyers here. When you're out there with these higher end people, what is that makeup? Are they foreign buyers or are they domestic wealthy people, or is it a combination of both? I mean, I spent years in new development sales, and for the most part, it was, I'd say, 75% foreign buyers coming to whatever building I was selling. I think that's changed.
I would agree with you. I think what I'm seeing is there are definitely foreign buyers who are they're tire kickers, but I don't mean they're not serious. They just believe that their cash goes further than it actually does in New York. The actual buyers who are transacting, I found it to be largely domestic. People who, like we've been talking about, have grown their wealth substantially over the last few years and who love New York, want to take advantage of it. There's still a lot of people are having liquidity events. Their businesses are selling. It's this confluence of like baby boomers who are selling businesses all of a sudden have, where private equities come in, bought out businesses. And what do they do with that liquidity? So now they're diversifying and they want to be here. There's some people who have made their money somewhere else in the country. They're empty nesters. I've had a lot of empty nesters who want to call it their last chapter, one of their last chapters in New York, because New York is really probably the best playground for aging that there is in
best playground
the
for
country.
Aging and for just about anything. Nikki, talk a little bit about the foreign debt. You have several foreign desks in foreign lands. Where are the foreign buyers today? Are they back as much as we would like them to be back, or are they still kind of slowly coming back to the fold in New York City real estate at the very high end, or just anywhere?
I'm going to qualify your question at the very beginning by saying there actually aren't any foreign buyers. We're finding them more global buyers. All right.
There you go.
There is not an element that is foreign to the U.S. anymore. They have integrated themselves here by going to schools here, raising their children here, coming on a regular basis, shopping or vacationing here. They don't act like foreigners, and they certainly don't see themselves as foreigners. So we do have global desks that are in faraway foreign places. We have had great luck with some, and others we've closed down, such as our Moscow desk, clearly around 2018, the Russia money stopped coming over here. Our activity right now is mainly from the Middle East, India. We also have a Canada desk that's done very, very, very well here on the East Coast and in South Florida. And our third desk is Asia. Asia is coming, and they're continuing to send funds cross-border, but stealth purchasing. The Asian buyer now is hyper concerned about security and privacy. So some of these mega deals are quietly being done by significant Asians whose money has come out of mainland through, in most cases, Singapore or Thailand. We are finding, though, the robust energy by Indians buying in the U.S. is something that's head spinning. We've all seen them. They started at the entry level just about 15 years ago. You know, that great young person that was coming right out of school. And then his family started buying. During COVID, they were buying at the mid-tier. Now Indians are buying at the uber tier. It's easy for them to get their funds out. They have a keen connection to the U.S. They have a great, great respect for it. They're coming, as well as Middle Easterners, not only for schools, not only for quality of lifestyle, not only for security, but also for medical help. All right, we still rule for offering the best medicine in the world, and aging billionaires want to be near and have close relationships with great doctors. They'll call me first and ask where I should buy. Mm-hmm. And the second call is, by the way, when I'm in town, I need an internist. I need a heart surgeon. I need some. Could you put me in touch with? We offer so much from this country, specifically from this city, that I think that we are going to continue to be the go-to place for many decades forward for people that have extra wealth to enjoy and spend.
I would just to piggyback to bridge some of the things that both Nikki and Scott said. So there's a few comments, right? One is there's so much wealth on the sideline, right? You look at how much money is in the money market funds, it is ballooned because you're getting a return, at a relatively, risk-free asset. But now it's time to enjoy some of that money. We talked about the liquidity events. We're coming into the greatest transfer of generational wealth that we've ever seen. So the liquidity event is, yes, coming from, people selling companies, and we're seeing a continuation of a compression in terms of the large guys swallowing up the small guys and people selling out. But we're going to have this generational wealth transfer that is going to fuel the next generation in purchasing properties. You see it incredibly so from India coming here, who've come to school here or come to work here, and you see it with the Asians. We've done a ton of deals recently, mega deals, 30, 50, 75, 100 million, deals with wealthy families coming out of Asia, namely China, and they're doing it in the names of their kids and buying it through. So you're seeing it in a few different ways that people are coming here because they want to have a life here, right? And wealth now is intrinsically global, and it's about stacking your assets in the destinations that afford you the flexibility to live different things. And medical tourism for New York is 100%. We hear about medical tourism, leaving the U.S. for cheaper care. But again, that's on the lower end. If you're talking about the wealth and the luxury type of consumer, they want the best of the best, which is here. And we've seen that as well. People coming here initially for, a hospital stay or for treatment, and they may rent for 2-3 months, but it's tough, right? You'd much rather have that place, especially if you need to come back for, routine care with follow-ups.
All right, we're going to take a break. We'll be back right after these messages. Don't go anywhere. Okay, everybody, we're back. So, Scott, let me ask you a little bit about, again, you alluded to before the domestic wealthy buyer you seem to be seeing a lot of, in addition to the global buyer, as Nikki defines it. Does inflation affect their decision-making process? Does the overall look and feel of the economy in the U.S. bother them at all in their purchasing decisions, or are they just moving forward? Because, as Jared said before, there is so much money built up in their private portfolios that, I mean, it's just available to spend.
There are a few things in there. One, I would say that inflation, they see this as a hedge against inflation. So they're buying real estate and just diversifying their portfolio that way. The other piece is that, not just the domestic buyers, the foreign buyers have seen their currencies grow in value compared to the US dollar. So they actually are, when they're making this move, it's a double move. Somebody who bought in 2009 from England, the pound was $2. And then, you see it now, it's almost at par. That was an incredible move. And we're seeing other currencies like the shekel in Israel had been very strong for quite a while. And you can look around and see where that's the case in other currencies as well. They move into the US dollar. Now they've got this asset that both is a hedge against inflation, and if their currency becomes less strong against the dollar, they win double, right?
Correct. Jared, talk a little bit about Forbes Global Properties. So your Elegans alignment with Forbes. What type of buyer and where are they coming from to you guys at Elegant? What countries and what type of buyer is actually being produced by that alignment?
Sure. So Forbes and Forbes Global Properties has been such a powerful partner for Elegant because we have now one of the largest media giants behind us. And, real estate is nothing else but content, right? Yes, it's an asset, but in the Forbes speak, it's content. And everyone loves their, real estate porn. So getting that out there and being able to have these properties now put across the world has been incredibly powerful. We also have great relationships with our partner firms all across the world. In terms of where we're seeing tremendous buyers coming in, again, it echoes a lot of the sentiments we've been talking about with India, with China, but a lot from the UK. There is such a reciprocity between London and New York that, especially with them going through Brexit and everything like that, we're seeing a lot of buyers coming from there. After the Russian invasion of Ukraine, we actually saw an incredible uptick of buyers from the Baltic states, namely Estonia, where they were looking to diversify and they were concerned about their, Eastern Front. And we did a few deals with wealthy Estonians, to a lesser degree, Latvia and Lithuania as well. So there was a brief flurry there. Certainly, the Russian money has definitely drawn up, but the Middle East continues to be big. Not so much, though, from South America anymore. There was a period, at the end of 2008, 9, 2010, where Brazil was heavy. But again, the currencies in South America have been so deflated against the dollar that it just makes it not really practical for them to purchase.
Is there a concern, though, with all these global geopolitical issues going on in the world, the war in Ukraine, the recent issue in Israel? How does that translate into the New York marketplace? I mean, it seems to be right now, to me anyway, that the world is upside down. I mean, it's easy to say that and not necessarily back it up. But from a real estate perspective, how will that, or is it affecting the mindset of people coming from global markets to this town of ours, to this city of ours, to this country of ours? Is it having any kind of effect, Nikki?
Yes, it's definitely unsettling, specifically for U.S. buyers. Those are the ones that are caught right now in this period of uncertainty. Which way is our economy going? And the distractions and the significant reasons for these distractions with the double wars going on right now is giving them pause. On the other end of that, the international buyer, some of them are fleeing to the safety and the security of the U.S., New York as well. So I think that this kind of activity stimulates some into putting into seeking out and collecting homes that will give them a sense of security, a sense of growth in their wealth portfolio, while others, particularly New York buyers right now, they're just waiting for some calm waters. We're certainly looking for some calm waters because there's so much else going on right now. Earlier we were speaking before the podcast today, Vince, about concerns about crime in New York. May I mention that?
Absolutely.
Okay.
That's next.
I don't think New Yorkers have any concern about crime because they're not seeing it. They're not part of it. They're not involved in it.
100%.
It's invisible to me, but there is a lot of press out there internationally about the elevated crime in the U.S., specifically New York. I'm wondering the reason for that. Is that a way to keep their funds in their own country for those people that are, offboarding
There you go.
their funds, making New York in the U.S. less attractive? The smallest little piece of crime that is not even anywhere close to our front pages hits everywhere in Europe. As I mentioned, I was just in London last week, and numerous questions that I had from all 80 of the owners that, again, were in Europe, Middle East, India, and Asia was, how is the crime in New York right now? They all wanted to know, is what they're reading true? Should we wait a while? Is this a safe place? I do want to send my kids there. I do want my grandchildren to grow up there. So I think we have to do a better job of actually presenting the reality of quality of life in New York. We certainly know what it is. We need to make certain that it's out there.
I couldn't agree with you more. We, as New Yorkers, understand what quality of life is here. We understand that the crime issue has been blown up. I mean, a couple of and I don't mean to minimize anything here, but the couple of instances where there are issues on the subway trains or wherever get blown up globally to New York has a major crime problem and stay away from New York and whatever you do not take the trains. Okay, in a city of how many? 8 million, 9 million people, you have one person that gets a little cuckoo one day and it's like, crime is awful here. It is not, okay? Trust me.
And I think a lot of that comes from the larger geopolitical forces at work,
there you go.
right? You have other countries trying to weaken America's standing on the world stage. So it has
100%.
nothing to do with New Yorker crime. It has to do with the larger picture about painting that America doesn't have its own house in order. Right?
I would, I just would want to point out that for about 2 years, a solid 2 years after COVID, people still were asking me, are people still moving out of New York, Scott? And I'm like, this is
I
crazy.
still get that
People,
question.
they get this, this headline from 2020.
Yeah.
And look, it wasn't in preparation for this podcast, but I just watched 3 days of The Condor, which is like a 1975 movie.
I was going to say, that goes way back.
Right. I'm thinking about all of these, this portrayal of New York as this place of crime and like real violence. I used this word before, it's a playground, but if you go around the streets of New York, you will see packed restaurants every single night.
Every night.
And people love New York for the same reason they might be a little bit concerned about it. It has a grit. It's alive. It's bustling.
It has a grit, and like any other big city, and probably more so here, it's big, and there are lots more people here. So you may have these feelings of being uncomfortable once in a blue moon, but that happens anywhere. But overall, I wouldn't want to be anywhere else. I feel safest when I'm here. I visit family sometimes up in Westchester, and I'm like, I feel better when I'm in New York.
It freaks me out to be in an empty house at night.
It does.
Like, what is this place?
It does. I hear the wind blowing and the shingles moving.
Give me the doorman.
No.
Give me the doorman in front of
Nikki, you wanted to say something. I'm sorry.
I do, because
That's very true.
because you're absolutely correct that geopolitical elements are at work here in devaluing New York and keeping their money at home. How we're combating that are the people that do come over, and certainly have been coming over in masses recently. I mean, you only had to walk through the streets this summer and then through the fall and now during the holidays to see and hear all the different international languages. They're going home.
Wonderful.
And they're telling their friends,
Exactly.
they're telling their partners, they're telling their associates, New York was incredible. The U.S. it was very safe, and we've doubled down. We're buying real estate there, and we're sending our kids over. So I think word of mouth will continue to right this unfortunate misrepresentation.
And that's the important piece and the benefit of the New York market is we have so many different factors that make up the buyer pool. So when rates increased and the first time home buyers, went home or stayed renting, we had the international, we had the luxury consumers, and that's the benefit of our market. And I work closely with Jason Thomas, Elegran's director of research, and we put out this research article about 1.5 years ago, and I hope we don't have to test it again, but the premise of it was, New York City is catastrophe proof, right? Looking at what happened after 9/11, 08, COVID, the prices don't really
Sandy.
fall.
Oh, I like
Sandy.
Sandy, absolutely.
And the reason is New York performs like a blue chip asset. It's not like Boise or Austin or these other, tech stocks or tech type markets that rise and fall rapidly, right? You look at Austin prices, doubled inside of 18 months and have fallen by about 30% shortly thereafter. But New York is not going to rise incredibly fast, and it's also not going to fall by a large margin. So it's that steady eddy. It's buying the Dow, right? And that speaks to the international consumers that want to be able to enjoy New York, but also protect their assets. It's why we got that, Swiss banking kind of real estate moniker a few years ago.
If anybody, I would say one thing too. If anybody wants to test this theory of that New York is somehow not popular, go try to get a hotel room for under $500 a night, right? I mean, the hotels are packed. My friends who are hoteliers, they can't, they're very excited after what happened during COVID. Hotels are packed, prices are up, people are here walking the streets.
And you
from
talk
everywhere.
about restaurants being packed every night along all of the avenues that we, zip by in the evenings. Prices are high, right? But the restaurants are still packed. This is an environment where it almost seems like nothing matters. It just, life continues. Let's, though, talk about the neighborhoods or even some of the buildings that play in these higher-end luxury markets. Is it building-centric that these wealthy people are coming to? Is it neighborhoods? Is it a combination of both? Nikki.
Okay.
That's a good question.
Since we have a variety of buyers at all price points from a variety of locations, I would definitely say it's a variety of goals. If they're young, they want downtown. Okay, no doubt about it. Okay, downtown has risen.
Define downtown.
Well, for me, it's anything below 42nd Street. But we well know that Tribeca is the ruling area.
Yeah.
Soho coming in second. The Gramercy, Greenwich still has a strong attraction rate too. By virtue of inventory, it is limited. So if I have someone who is budget conscious or, would prefer not to spend $20 million downtown and only wants to spend 15, I definitely direct them up to the Midtown Arena. Older wealth wants Billionaires Row.
Yeah.
They want it, and if they first asked for Fifth Avenue, and there are limited opportunities there because we have limited condos there. They went around the park, Billionaires Row. They know someone who's bought there. But again, we have to show them best in class. There's so many opportunities for them and their differences in caliber and quality of inventory.
There really
I think
is.
it's the whole city. I know you're going to touch on some other neighborhoods. I'm taking exception with some I saw on your list because I can't tell you the last time someone asked me to take them to Hudson Yards.
Hudson Yards is a huge
I was just going to go ahead.
Before we go there, though, there are winners in every neighborhood, right? There are buildings. There are certain buildings.
100%.
Just to touch back on your question, there are certain buildings in Chelsea that have won, right? Their quality has stood out, and buyers have reacted to it. You could look at something like One Highline, for instance. Yep. That's been a really well-performing property. You can look at something in Soho. You could look at the Upper West Side. There are some buildings that have not performed nearly as well as something, as others on Central Park West. So location, so many developers built on maybe marginal locations within neighborhoods, and they haven't always done well.
It's the reputation that the building takes on, right? You get these cult buildings, and it's not just in real estate that this happens. I was reading something last night that talked about like the top 10 cars that had the best, value retention and the top 10 that had the worst. And again, the same thing is true. There's certain cars that just become the cult classic. Porsche 911, the Wranglers and things like that hold their value. The same thing is true in real estate. Look at the Caledonia. It was the first building that was really built to that scale on the High Line.
On the High Line,
That is a cult building. How that building has retained and grown its value is a little bit of a misnomer and a complete shock to me, but it has, right? Each, to Scott's point, every neighborhood has it. So to answer Vince's question, right, it's neighborhood first and then building second, but there are certain winners and losers based upon, the quality, based upon, who ended up moving there, and ultimately the word of mouth and how that story has been told for that building.
Let's not undermine quality. Let's make certain, because when you have an inventory-laden environment, as we do in New York, quality matters. You take a buyer on a tour and you give him his top 10 options, all right? He's going to suss out immediately the best built, the best finish, the best views, with the best amenities, and that matters. He will pay what he needs, he or she will pay what they need to get the best. Those mid and lower level quality, Mr. Developer, please listen to this, up your quality.
Right.
People now know what they want and they're expecting the best. And if you are being cheap, they recognize it, and you're seeing your sales also being cheapened.
There was something on the east side, and I won't name names, but there was a building that did very, very well. And when they delivered the product, it just wasn't up to snuff. It was really a disappointment. A lot of owners, buyers, they closed. They felt they had to close. And reputationally, the building will be damaged because ultimately, like, the resales will suffer and people are renting out their units. So, if you're trying to build something that will last and grow in value over time, you definitely, I'm totally agreeing with you, Nikki, that you need to build quality because the prices are justify delivering that level of quality.
Well, they do, but I've sold many years a new development, as I said at the top of the show, and I sadly can say that in some cases, certainly not all, the quality of these buildings after delivery has really not been stellar at all. And as you said, Scott, it affects resale. It also kind of gives the building a bad name because your attitude changes. And so when you're talking about the ultra wealthy wanting to come in to a building, I believe what Nikki said before, that quality issue, if it isn't, it should be number one. Let's talk about some of the top, and I agree with you, some of the top 10 most expensive neighborhoods here. Hudson Yards, number one. I agree with Nikki.
It's only because there's so little inventory and everything is built luxury.
But they're not even selling that magnificently, right? So I get Soho, all right, number two. Central Park South, okay. Obviously, Nolita. Tribeca. See, I would put Tribeca up in the top three.
That's where I would have it number one.
Well, that too, okay. Hudson Square, all right. NoHo West Village.
Now we're getting creative.
Okay, Nomad and Carnegie Hill. Carnegie Hill.
At the bottom of the list, it's screaming opportunity.
Right.
Why is that? Because they're plethora of co-ops versus condos.
There you go.
We're talking about a different structure and a different type of buyer.
and different qualification.
Different qualifications, and
different
I'm
disclosure.
sorry, but the co-op structure may be a dinosaur because so many buyers now do not want to go through that extraordinarily grueling an opening of the kimono. Co-ops had a time and a place, and they certainly had added value because they were so discriminating. They really were. People wanted to arrive by buying into the right co-op.
And they still are discriminating.
Now
for the
they
most
do
part.
not. Now the buyer, no matter what their age, doesn't need that stature.
Right.
Doesn't have to be in a significant Park or Fifth Avenue co-op. They want the best, and they will pay what they need
I
to.
still want
and
Park
they will-
Avenue.
Well,
But they want to buy in an LLC.
Yeah.
Right?
Yeah.
the test case, the test case will be in a couple of years. So you look at something 79th and 5th, right? And then right next door, 980 is the co-op on the north side of 79th and 5th. Views are incredible. Next door, Elliot Spitzer's family is going to tear down its rental building
100%.
and build what will end up being the most coveted uptown location because it'll
You
be a
heard it
condo.
here.
Right.
It will go. Those sales will be incredible, and you'll just look at one versus the other. 980 has beautiful units, great views, but they're struggling because
So for
it's a
those
co-op.
of you who are listening to this and looking for opportunity, it is in the co-op, in spite of what I've just said.
And
It's where you can buy very, very well. And those co-op sellers, most of them, are rational and reasonable about selling. They've enjoyed their 2 decades there, and they will not be exiting at this time at a profit, many of them, but they're ready to go. So focus on that if you can, in fact, embrace the co-op structure.
And
All right,
you've
we have to take another break. After that, I want to get a little more into the co-op versus condo scenario in all neighborhoods because I agree with what you just said. We're coming right back. Don't go anywhere. Ready to go. Okay, so let's talk a little bit about the co-op scenario because on the one hand, people say that it is a very good thing to do right now because they're selling cheaper than they ever were. However, and we all know that the condo is a lot more expensive. However, the board scrutiny in a co-op can be maddening, right? And not for every buyer because not every buyer can qualify for that. What are you seeing on the very ultra high end when it comes to whether they want to buy, a buyer wants to buy a co-op or a condo? Are they buying co-ops at all?
They are buying. I have a property, 778, that we just rolled out last month, and it looks like we're going to have it done after 20 people were in, and 4 of them were negotiating on it. It's priced correctly for the market, but what we also have is a reasonable, tolerable, and open-minded board there. If you
that helps.
have the opportunity to have board members that understand this nuance and this change in market demand, they are becoming far more reasonable on what their structure is. More of them are permitting financing. I mean, can you believe that financing now at numerous great high-quality buildings? One only has to look at the River House to use that as your textbook case. For
I love that building.
It is probably the single best
Yeah.
architecturally built building, but the textbook case, Harvard textbook case on co-op mismanagement, the values there, they missed the run-up because of a discriminating board, and now the owners are suffering. So we need enlightened board members that understand that they have to compete with the new gal in town. The beauty queen is the condo, and how are they going to do this? By not only permitting more flexibility of purchasing, but accepting lower price points.
Right.
That was our big problem with most co-ops. We would give a totally reasonable board qualified candidate, and the board would look at the price and go, oh my God, absolutely not. My property just went down by 30%. Rejected.
And that's the boards have to modernize and have to change. The next generation needs to change the policies because, as Nikki was saying, it is a completely false, expectation to think, well, I'm going to turn down one and the next one's going to come back higher. No, every time it's going to come back lower. And co-ops have continually missed the mark because it's the who moved my cheese, right? They were the only game in town for many, many years, the best of the best, because the early condos weren't, what they are today. But now, especially again with the international buyers coming in, if co-ops don't modernize their policies, if they don't relax the financing, if they don't open up to international buyers, if they don't evolve, they're going to continue to price themselves out of the market. And that's what's happening because you can still...
Therein lies the rise again of townhouses.
Exactly.
All right, if you're going to be on the Upper East Side, which is at the bottom of Vince's list on
I'm
values
shocked at that
here.
list.
We all are, but we've learned something here today. Townhouses, the security of New York, the opportunity to buy how you want, when you want, at what price you want, and operate it as you want, is again rising. And we're really thrilled about that because the quality of life on the Upper East Side in a townhouse cannot be matched. It's as good as it gets.
Can I say one quick thing? Because we were talking about co-ops. I represent a bunch of buyers. We're in the market looking, say, $5 to $10 million at that price point for co-ops. The issue isn't always the discriminating co-op board. It's what are their policies around renovation? And frankly, so for instance, do they allow you to put central air conditioning? So if you're spending $5 to $10 to $20 million, that's something you probably want. Do they allow you to put in a washer dryer so some real basic stuff that some co-ops can't get their heads around allowing. So that can be a real problem.
And when can you do the work?
Right. And then of course we're getting into the construction itself. So what I've seen is
Which is problematic.
So actually co-ops are selling rather quickly if they're in beautiful mint condition. Right. So some people don't want to do the work right now, not necessarily because it's a headache, but it is for people who don't live here. But the bigger picture is, oh my gosh, I don't know what I'm going to spend. And the cost of renovation has skyrocketed to the extent that you look at it and go, well, this price has to adjust so significantly. There's a sea change in pricing for co-ops because they have to be renovated. So you have to look at new development. You say, all right, well, something sells for $2,500 a foot. And let's just say a condo conversion like the Bell Nord, which is on 86th and Broadway.
Right.
The renovated high floor units will still sell for $2,600, $2,700 a square foot. The unrenovated units, that's the question mark. What are they worth? If you go to talk to any high-end contractor, some of them will say, we start at $1,000 a square foot. Well, A plus B, if it equals more than the finished product, you have a problem.
$1,000 a square foot, it's beyond.
And you can buy, the co-ops offer huge floor plates, right? Some
Yeah.
of these story buildings, they offer stuff that you just
Sure.
can't buy new. So there is a scarcity. I mean, we've done some valuations, and we leave our head scratching because you're talking about 4, 5, 6,000 square feet of contiguous, open, prime to be renovated, but there's nothing else on the market for it, right? So there's a scarcity issue, but then you have this huge question mark of how much I want to spend to finish it, and you can't buy that new, which is true, but it's a headache to have to go and get it done.
This whole situation opens up something that's rather new to many of us in the industry, the retrade. I'm sure you've all been seeing this. I certainly have had way too many of them. We get a buyer who's embracing doing the work and the structure, the qualifications to get into a co-op, buying it because it is an opportunity play. Still can't find something that's done at this exit number. They sit and think about it. They talk to more contractors, more architects, more designers, and after they accept an offer, they come back and they retrade. And then they'll retrade again. And I'm going to give you a great example. It's very close to me. My daughter and son-in-law were purchasing a co-op recently, all right? And for the last 6 months, they've been retrading an accepted offer. You know how embarrassed I am to be representing them? But as they learn more about the costs and the timing and the restrictions, the valuation, it's not a game for them. The valuation begins to plummet. And the whole idea is, do I go into this and enter this? Or do I? It has to, or it has to be a really compelling reason why I can't walk away from it. So the retrade is new.
So the elephant in the room, or the $1 million question becomes, okay, and this town is more co-op than condo, still.
Still 72%.
Correct. Thank you. What's the future of co-ops in our town that we know and love and work in for many, many years? What is the future of the cooperative building in this town?
They still provide best location. They still provide
do.
extraordinary architecture. They still provide, as Jared said, great floor plates. And many of them are small, and it's a boutique lifestyle with all the services.
Yes.
The future is a rethinking of the structure. Newer, younger, savvier board members who understand the value of what they have and how to make themselves attractive in a competitive market. That is changing. Many co-op boards are embracing our industry's advice and adapting and changing.
Right, we're meeting. We're constantly. I'll get asked by a condo or a co-op board, "Can you please come present to us? What can we do to increase shareholder value?" It's a very straightforward question.
When I'm asked to do that.
It's the
Love
best.
It. Mm-hmm.
And then, sometimes we look at those situations where co-op boards will either reject a buyer or participate in some kind of shenanigans where the contract price isn't what the actual price is. And I think there's just a transparency and a reality check that co-op boards will have to.
May I make a plug for Brown Harris? Because truly, there are a variety of managing agents in this town, but Brown Harris has been the most flexible, the most agile in looking at the adaptability of how they're going to stay with this market. And all the buildings that we've been selling in the last 2 years that have Brown Harris management have been far more flexible than others. I think they're giving very good advice to their boards.
The co-op boards need to be educated about who is the consumer, who's the buyer for these buildings, and there's this. Some of these buildings do have they call them NORCs, natural occurring retirement communities. People live longer, and so it becomes I
haven't heard that one. That's a good one.
It becomes kind of ultimately a race to see. Who evolves, and within the co-op community, I think there will be winners and losers too. I can think of something on the Upper East Side. I know the co-op board president. He's a very successful guy. They changed their financing to allow 66%. They are not as strict as they were, and lo and behold,
they're going to sell.
They're selling their units. They have a nice community of people. They're not getting. They're not unhappy with the people that are buying. These are nice people, and it's going to work out just fine.
When you look at the buyer pool today, the millennials, and I hate to use that term, but anyone who is younger than the typical person living in a co-op, they don't have the patience that the older folk, and I use that term lovingly, have or had with their co-op boards. These young Turks coming in don't want to be hassled, and they don't want to be told what to do and what not to do. So, as Nikki indicated before, slowly, as you turn over the board members of these buildings, that is when I think things start to change and things start to become easier, changing the financing. How many, when I first started, how many buildings were 100%,
All cash.
all
yeah.
cash, no financing,
With
50%.
2 times the purchase price and liquidity post-close.
And that's another thing. So, even though a lot of these younger folk are making big money,
don't
that's
have the
not what they
liquidity,
want to
right.
do. They don't have the liquidity, and they
So the
don't want to do that.
lesson learned here today is because of the buying opportunity in co-ops, perhaps if you're a buyer right now, you really should be seeking it out. We know there's going to be a transition, and if you're planning to be in there for at least a decade, you will see the benefits of that transition.
Yeah, 100%.
And I've seen on, West End Avenue in particular, there's a few co-ops that have had that evolution of the, board control, and they've changed their flip tax to, charge to the buyers, right? And they do it as a way that it's improving the building. They've actually bought back a few units, increased amenities, changed the policies, relaxed some of the stuff, and it's allowing the building to function more condo-esque, which has allowed the building to, ultimately upgrade itself, through that process. So,
Let's quickly talk. We have a few minutes left. Let's quickly talk about off-market sales. I seem like it seems like rather it goes in cycles, right? You either get a lot of requests for off-market and then you don't get any. And then you get a little more and then it goes back to being a lot. Right now I'm kind of in that a little bit to almost too much. What are buyers looking for when they come to you and say, I'd like something off-market? Do they think they're getting a discount? Do they think they're going to get a better deal because there's not a situation where many people can bid on it? Hot markets or slow markets? What are they looking for?
The buyers think they're going to be getting an opportunity, steal, all right? Off-market
Steal.
is never a steal.
Never.
In fact, just the opposite. You're going to
thank
pay
you.
premium for
Thank you.
off-market. Why would you pay that premium? Because you're in a solo. You have the opportunity to snatch something that's valuable and rare and fits your needs. If you believe that a seller is going to take anything not close to his asking price, you are incorrect, because that seller has the opportunity to build up your competition and put it on the market eventually. So
Absolutely.
if you love something and it's off market, you need to do exactly what's expected, which is to pay that seller his number.
And I tell them all the time, it's not on the market for a reason.
Right.
So it's not negotiable. It's not this. It's here's the price. You like it. You want it. Buy it.
Another reason people are asking for off market, though, is we have these serial showings now. People used to be in the market for 2 to 3 months, all right? They learn the entire market, they saw the inventory, they make a decision. People are now in the market for years. I mean, many of our clients, 6 months, 9 months, a year and a half. And they
27
have
apartments
this
later.
Huge appetite. Show me more. Show me more.
It's like the
It's a hobby.
It's a generation of buyers who I got married before the dating apps, but there's always something. There's always something next.
Better.
There's always something next. It's FOMO, right?
Right.
And
That's a good
it's a fear.
analysis.
It's a fear of missing out. Just to touch back on what buyers want off market. On the Upper West Side, where I do a lot of business, there are side-by-side units. Sometimes there are combination opportunities that will be, I will know both sellers or I will owners. And if we can put a deal together, they know they're going to get a premium that both it outperforms the market, and it probably is a good opportunity for a buyer who simply can't find a 4 or a 5 bedroom apartment to buy. There's just nothing on the market at the time because it's so rare anyway. So I think
Right.
that does the off market there. I think is a win-win-win, right? The sellers win because they get maybe a premium to what they would have sold their own apartment on its own. The buyer wins because they get this huge apartment.
And it's worth more
and
to
I
them
and I
than
win
anything
and I
else.
win
that's-
also
It's the intrinsic.
It's
because
all
I get
about winning.
very happy, very happy
Absolutely.
clients.
It's all
right?
about winning.
It's
Absolutely.
intrinsic value, right? So an off-market deal does a few things. For a buyer, it's because they find that intrinsic value that's worth more than the price that may be. There's also a sense of pride in being able to say, hey, I got this off-market, right? That's part of sort of the status symbol. But at the end of the day, they're exhausted the inventory, right? We have fundamentally, quote unquote, a lot of inventory, but we don't have a lot of good inventory. So you always want to go and try to find that something else. I mean, I did an off-market deal where, the buyer paid 2.5 times what it was worth, but there was an intrinsic piece that it was worth it to them for a certain reason, and you get it done, right? So that's, it all comes back to how are you creating that value for someone.
There is a misimpression, right? Buyers sometimes think that there's distress in this New York City market, Like that is probably the biggest mistake that a buyer can make, to think, I'm going to find this steal off market because, this broker is that great. And frankly, like there's just not a lot of distress. People have put so much money into their properties.
If it's distressed, it's not off market.
I mean,
Correct.
It's out there.
I mean,
It's
we
out
just
there.
did
And long time.
there was something on the market that a client of ours bought in Harlem, a big apartment in Harlem, and the seller just happened to be filing bankruptcy. And boy, what a pain! That distress was not worth it. 6 months later, we're still waiting to close.
Right.
As a market, though, we have to thank the co-op structure for making this market not have pain, right? Because of the high financing and the high liquidity requirements is why, New York City hasn't dropped in any of those events we mentioned, a few minutes ago. So it is all because of the co-op structure that we have this, liquid but also
Protection.
relatively safe, investment.
All right, we have 1 minute left. Last question. So what is your sweet spot in working with listings or working with buyers, and why? Nikki.
Oh, why do I have to be first? Okay. All of the above.
All of the above.
Okay, obviously right now it's a buyer's market. So we hit a home run with every buyer we have. We have to stay with them a long time. They come to the birthday parties. They come to the christenings because we know them for so long. But ultimately they do buy.
That's funny.
They have comfort in the fact that we were out there. Sellers, it is a tough love, all right? We have adapted our skill sets with our sellers to tell them what they don't want to hear, but what they need to hear, which is correct pricing. So we don't mind at all. In fact, we embrace sellers that look at us as the professionals that will take our advice and will price accordingly. If they price accordingly, we'll get it done. So I think, as with all professions, we have to evaluate our clients, and if they're not realistic, drop them. And if they are realistic, get all guns blazing and get it done for them. So we love both.
Scott,
Repeat the question for me, Vince.
your sweet spot in working with buyers and or sellers or both.
I run a team of 10 at Brown Harris Stevens, so that gives me the opportunity to say yes a lot more than I would otherwise. But our sweet spot can be in the $2 to $10 million range typically. That doesn't mean that we don't have people on the team who handle lower price points. And I think to Nikki's point, a lot of what our seller work is this year has been really navigating how to properly price things, how to do price discovery, and frankly, to know when to hold them and know when to fold them. We've had a number of sellers who said, "Let's regroup next year."
Is that a song lyric?
I think that's Kenny
Kenny Rogers.
Kenny Rogers, right?
Yeah.
But ultimately, I've found after 20 years of doing this that we've never been more valuable as advisors. That our buyers are to be strategically thinking with our clients,
Yes.
buyers or sellers is so valuable. And yesterday I was talking to an agent in the Hamptons who's done over $1 billion of business this year. He said some agents, he called them single cell organisms. Right. I mean, we don't have to get into what's going on in the world, in the courtroom right now.
Right.
But there's a reason why there are great agents.
Yeah.
And what sets them apart is this ability to be a strategic thinker. I think we are that kind of a partner to get through these uncertain times and to help them understand what's value and what's not value.
Again, advisors, not salespeople.
That's right.
Oh, I took that term from you. The first time I met you, when you called yourself an advisor, I said, I am an advisor, according to Nikki Field.
Because you naturally gravitate to people of influence who are advisors and shy away from salespeople.
Well, as she said before, you kind of advise them on
Correct.
life, right? Not just on your real estate
Totally.
transactions,
Correct.
but on life. Jared, you get the last word.
So I was walking here this morning and I saw sitting across the lamppost all these pigeons. And my thought naturally went to real estate from that because the buyers all are waiting on the sidelines, right? They're all waiting to spot, the dead animal or spot the good deal, but they're going to miss it, right? The time to buy is now. The pain is most heavy in the market and it's starting to ease as we round out the spring. If a buyer waits for an interest rate to drop, prices are going to go up. The only reason prices have stayed flat or gone up even now is because we've moved from being a demand-driven to a supply-constrained marketplace. So buyers, when interest rates drop, there will be more competition in the marketplace and prices will continue going up. So do not be the last pigeon waiting to go get your food. Move now. You can marry the home and date the rate and always refi later. Buy when you have the opportunity to negotiate a sweetheart deal for yourself. Don't wait till it's too late.
Bravo.
Bravo is right. We're coming right back. Great conversation, guys. Thanks so much. We'll be right back. And that's our broadcast for today. Thanks to my guests for being here on set with me. You can follow me on Facebook, on Threads, Instagram, or TikTok at Vince Rocco, or my website, thinkvince.com. In addition, if you want to email me here at the show, you can at talkingnyc@bhsusa.com. Einstein once said, compound interest is the eighth wonder of the world. He who understands it earns it. He who doesn't pays it. And to my viewers and listeners all around the world, from all of us here at Talking New York Real Estate, thanks once again for spending a part of your day with us, and I will see you next time. Goodbye, everybody.